Thank you very much for giving me your time to join me today for our concluding panel. We're going to get some buy-side views on portfolio strategies, or more specifically, where's the appetite for junior mining at the moment at this point in the cycle. So with me we've got Pete Major from Mergence, John Hodder from Tembo, Mark Sawyer from Greenstone Capital, Mandi Dungwa from Kagiso Asset Management, and Verne Grinstead from ANRH. So thank you very much for joining me, everyone. Let's press on. And perhaps why don't we take it from the top around that initial theme. How do you play the market? And how do you play the selection game or assess junior mining companies at this point in the market? Does anyone want to take us off with that? Pete?
You want me to lead this?
Yeah, let's go.
Look, we're seeing it from both sides. At Mergence Corporate Solutions, I think we attract 1 out of every 2 people who have a prospecting right in South Africa. And we probably attract 1 out of 10 who have a mining right. And they think because they've got this piece of paper that all they got to do is come to us and we just open the safe and give them the money. And then when I say, well, we've used most of our money the last 10 years, we're going to have to open somebody else's safe. They say, great. When do you want us to meet with them? The fact is, money has never been easy since I've been in the capital raising, and that started in 2006. It did flow in 06, 07, and then with 8, it crashed. And in this country, it's never really recovered. And that means the foreigners haven't poured money into this country like they used to. And we know that there was a recovery in mining back in 09, 10, 11, 12, 13, but it avoided this country. And it was easy to say, well, it's the legislation, it's the BE, et cetera. Without a doubt, that was one of the main components. But since then, this country has added on Eskom, it's added on the community mafia, and we can't complain about the world. It's on the macro side, commodity prices have recovered really well. All the commodities we produce, other than uranium, are doing above their long-term means. And like PGMs, iron ore, are doing standard deviation above their means. So on the macro side, I'm very positive. The rand is weak enough to make every project we've got look very attractive and give good paybacks. Government's slowly trying to amend the MPRDA. They're slowly trying to address Eskom. But the bottom line is we're being very choosy on the projects we select. We select projects that have a history, that are brownfields, that have a lot of good data, that we can show the presenter most of the traditional risk is taken out of this. We just need a little bit of capital. And we've got a plethora of them to select from. This country's got 6,000 abandoned mines. We try and target the best 1%. But yeah, the capital, I'm surprised it's this hard, even for South Africa. In this presentation this morning, the only reason they really had it was hard was ESG. Mining's got a bad image, and that's worldwide, which can only be a part of it, I think.
Yeah, I think that's the wider debate, and perhaps we'll get onto that in a second. But Mandi, you're also based here, but you look predominantly South Africa, but globally as well. Would you agree with Peter's sentiment there about it being hard to deploy capital at the minute?
Yeah. Hello. Yeah. I would say maybe slightly a little bit more, just slightly a bit more positive than Peter is. I do think sort of the mining charter, MPRDA, those continue to be concerns. But definitely, I think with this current regime that we have seen somewhat of a turning point from what we experienced, I guess, in what is called the 9 last years of South Africa. This mines minister is a lot more willing to engage on some of those issues, which I think is positive. But you do need resolution and policy certainty, which still needs to be resolved. Obviously, Eskom, as I'm sure most of us have experienced, is a problem. The lack of power, and for mines, that is a big concern. You need power to continue to operate. So that is an issue. But certainly, I think commodity prices have solved some of the issues for some of the miners in some key sectors for South Africa. PGMs continue to be a sector that was, I think, for a long time in the doldrums, and we've seen a significant turnaround in the last 2 years in that sector, which has been quite positive. So with most of the commodity prices, I think that element of mining is certainly less concerning than it was a couple of years ago. But SA-specific issues continue to be a concern, but I would add that this current regime that we have is a lot better than the one that we had a couple of years ago.
Yep. And just on your point on the commodities prices there, so from your own investment view, you're across sector, across commodity, and have you got any sort of favorites there that are performing particularly well? Is the PGM story, do you see that continuing long this year, and that's a very opportunistic thing to be happening in South Africa now, or?
Yes, so in terms of our own, I guess, portfolio, we had quite a large exposure to PGMs for quite a long time. So the last 2 years have been a welcome change in that industry. We believe that certainly this rally is sustainable. It is a fundamental story. It's a market in deficit. And we don't see that resolving in the short to medium term. So we think it is sustainable. But in South Africa, I think there was a presenter earlier who was talking about chrome and ferrochrome. That is certainly an industry that is, I think, 70% of the seaborne supply is South African. And currently, you've got a market that is significantly in distress. So the question is, if China continues to have a stainless steel market, where are they going to get their chrome from if prices don't get to a sustainable level? So I think that is an industry that is interesting to look at the moment.
Yeah. So, yeah, Mark, do you want to jump in on the commodities?
Just comment on what I think the point that Peter is highlighting is a really important one here, because I don't think it's a demand story. I don't think that's really the issue. It's a supply story, because the fundamentals do look attractive. You know, it took from the inception of mankind to about 15 years ago for copper demand to grow from 0 pounds of copper to about 11 or 12 million tons per annum, and it's taken only another 15 years for that to double. And so demand is healthy in pretty much most commodities. There are some exceptions and some better than others. And the industry itself is supply constrained-ish. But I think the main point that Peter was making, I think, is there is a complete disconnect between equity capital markets and the fundamentals of the industry. We're an industry that did have and still has a reputation for wasting capital, for not returning capital to shareholders. And I think it's going to take a long time to shake off that reputation. And a lot of the infrastructure particularly around the junior mining industry, the funds, the analysts, the brokers, have been decimated over the last, not just in Southern Africa, in Australia, in North America, and certainly in my hometown of London. And so I think if you're the CEO or CFO of a junior mining company today, I think a fundamental question you have to ask yourself is, do you remain listed? Because the capital markets for a junior mining company are not working for you. Your prospect of raising capital, you are swimming against the tide. And there are exceptions to this, but by and large, it is phenomenally difficult for juniors to raise capital from the public markets.
Mm. But that, as a private equity, that makes sense to me. But surely you also need a healthy public markets environment for exits to happen.
Well, yeah. If you're seeking to exit on market, I agree. I actually think a public listing for us, being private equity, is also a hindrance. Yep. I think if the market is not working for you, we tend to see across our portfolio amongst the listed companies, and they're not all listed, that the CEO is preoccupied with the share price, is spending a huge amount of time talking to retail investors with no impact whatsoever, even where the fundamentals of the commodity and the project are attractive. And so what I'm suggesting is that a lot more companies should be going private. And exiting a private company is a lot easier than exiting a public company, in my view.
Yep. Okay. Peter, do you have any retort on that? Peter? Sorry?
No, he's totally on board with that.
Look, we saw companies going private or delisting in the 90s. When I was a fund manager for Nedbank for 10 years, we had all the big mining companies, mining houses coming to us, and they wanted to buy back their coal mines because they just couldn't get their coal mines to trade at higher than 6, 7, 8 PEs, which was the same dividend that the coal mines were paying. And the big mining houses said, why are we giving away all this free, cheap cash? We're doing all the work, and these mines are 30, 40, 50% owned by people that are just reaping the benefits, and we're doing all the work. So they delisted them back then because they couldn't get ratings on coal companies. And boy, coal wasn't public enemy number one in the 90s like it is now. So that was brought out in this opening meeting panelists today, that look at our top tier companies today: Anglo-American, Billiton, even Newmont, and certainly Rio's. They're never going to get much higher than they are in today's PEs, and that's because the market's as high as it is. So the only way they're going to give an investor return, and that's the bottom line, Mark. And I agree, mining companies took for granted almost all the money they got from investors in the 90s and the new millennium. You know, when Goldman Sachs says they threw away $2 trillion in capital, that shows the total disdain they had. There was no efficient allocation process for that money. So I don't see any mining companies regaining a very good PE. And certainly the ones that we invest in, they have to show they're going to produce real earnings at below average commodity prices. If their commodity price is anything at the mean or above, I don't even take it to any of our investors because they won't go for it.
John, I'd like to bring you in here.
Yeah,
Any
sure.
comments on that?
Listen, I concur with pretty much all the interesting comments that have been made. Since we established Tembo in 2014, while I would say we've had nothing but a backwardation in the interest in the sector, especially at the sector we're looking to finance. And there's a number of pressures. And for example, I'm based in Australia, so I was a fund manager there prior to setting up Tembo. But for example, I'm aware of probably at least 15 small cap funds who just now do not have any exposure to resources. So where before people used to float to get that high risk money and there was a pool of it, we're seeing as the fund management business in Australia grows every year, compulsory superannuation, the fund management businesses themselves are getting larger and larger, and then they start putting in basically liquidity performance. So if you're not under it used to be, well, if you're under 100 million market cap, we just don't look at you. That's even much higher now. I don't want to get into a stock that's completely illiquid, X, Y, Z. So how do you play that market? Well, you can do, as we say, go private. But I think fundamentally, Tembo's position is we're looking for those projects that we hope an intermediate to a major will want to acquire. Right? We're not really looking for our exits to be selling shares onto a market.
Right.
And so that's a different mind thing. And as Mark has just indicated, a lot of the costs of being on an exchange, a lot of the energy that poor MDs have to do is facing a shareholder and all of those presentations, and it is very, very difficult. And, the money often can be saved and better spent if the market really wasn't the major consideration for the valuation that drives it. But it's very hard to put a project MPV down and say, we've technically de-risked this with a lot of money, and the value of this project is, say, X. Let's just pick a number, $500 million. Yeah, but your market cap's only 50. So I'm only going to give you money at this. Whereas if it's private, you can have a far more fundamental discussion on valuation with an acquirer who wants to grow. And we've seen it over a long period of time. When I came out as a geologist, the big companies employed a lot of geologists. Now, really, the likes of BHP Rio, they're just, they're of a size where they don't really mind if they miss the first $300 to $500 million of value creation. They'll just buy the asset if it's strategically fit and right. So the exploration is getting pushed down to more and more junior companies, and they're nimble and often very creative in their thinking and not constrained by being in a large organisation. But now they're not being able to get funded. So, and demand is continuing to grow, and we saw some interesting presentations. I didn't get them all because I was in and out. So, something's going to give, and it's just a case of when. And the rubber band can be stretched a very long time. But in the last 5 years, You know, we've invested in a very good project here with Orion. It's listed. It's a fantastic project, an old mine. But do we get any love in the room from Australian shareholders and even some South Africans? It's been a very hard road because we've been listed, you know?
Yep.
So it's probably better that some of these companies are private.
Do you think, and this is just playing devil's advocate, that companies are a little apprehensive of being private because of the level of control that a private equity will have over their, not decision-making process, but where you want that company to go, your majority stake in that company now? They're very much taking it your way.
Well, if they want to make money, because that's our game, and they want to do it responsibly, obviously, and everything, I don't see why we're not all aligned.
Yep.
You know, it's an alignment of interest issue. And as long as all those alignments can get done early and everyone is understanding, you know, what we're bringing, you know, we've had we had a very successful exit of a private gold company to Resolute in the last 3 to 4 months, and it worked wonderfully well, you know. He raised a lot of capital as a private company, and at the end of the day, you know, there was Resolute, there was also 2 or 3 others in the room, and to me that's our model. You know, when you ask how do you play investing, well, you're trying to pick that good geological deposit, because if it's not going to go to a major, it'll go to an intermediate. But we've only seen, the only market we've really seen any action in is gold, and you know, it's come back in the last 6 months. And yet you say iron ore prices are in a phenomenally good position, but the market just takes, you know, this view, well, every time I go to an authority, he tells me long-term iron ore prices are meant to be $55, so why be there? And so, you know, you've got this, you know, difficulty that a lot of people don't understand how the commodity cycles work, but are significantly influenced by what other people tell them about it. And, you know, you've got to kind of do your own analysis and work on that, because, you know, generally it's the commodity price that drives the equity valuation price if you're listed.
Yep.
Generally, in this smaller space. Yeah.
In the junior tier, yep. Any other comments on that? Verne, I've not brought you in yet. I'd like to bring you in now, yeah. You're with a new title with Appian, and what's your take on some of the things that have been said so far in terms of playing this point in the market for the junior tier?
Yeah, sure. I'm a senior advisor at ANRH, which is Appian Natural Resource Holdings, which is one of the main investment entities. But in terms of Appian, my colleague and former partner Jos Houman is sitting over there. He's one of the 3 senior operating partners of Appian, so good to see Jos attending so dutifully as usual.
You better be careful what you say then, Verne, I think.
Why is that?
He might report you back.
Naturally, the 3 of us here are sort of PE-type players, and therefore the private markets rather than the public markets are supposed to be the main focus. But I think there are many stranded public-listed companies that are small cap that are struggling to get institutional attention and equity research coverage, and it's a hard, long mountain climb, and for many of them, they won't get there. On the other hand, there are some interesting outliers, and one case study that intrigues me is the TSX-listed ERO Copper, which my friend Noel Dunn bought out of bankruptcy in Brazil, floated a year later on the TSX at $400 million, and it's now $2 billion, which John over there will be tracking closely. And that's a great story. You know, it shows that with the right size company, the right story, and yes, copper is super interesting at the moment, the public markets can still do their duty.
What were some of the ingredients of that project or that story that really drew that capital and then the valuation to rise?
I should almost ask John if he wants to comment, but my understanding is this was an over-leveraged situation. A huge amount had been spent on the company. it had gone into, I guess, bankruptcy, and there was a Brazilian distressed debt fund that had a stake and was sort of helping sort it out. And it's just a brilliant story, I think, all around, and lovely multiples of exit to the lucky investors in it.
I appreciate you always plugging our investments, so thank you. Yeah, no, it was a very good story, and a classic story in some degree, where nobody really knew about the asset because it had been held in a family for so long. As generational change occurs in families, often you'll find the grandfather's the mining guy and the young people are more interested in living on a beach or something. But for whatever the reasons, we helped the company finance it pre-IPO quite significantly. So we came out sort of the largest shareholder. We topped up at the IPO. We were 12, 13% of the register there when it finally floated. But the market got a new story that was in production. So it came out of the blocks in production. And, I hope that all of our other investments will be just as successful as Arrow, but when you're de-risking them for the next 2 to 3 years, right, you don't get a lot of love in the room. So, but a very good team on a very good asset, and, the market was ready. And I think, our biggest bet across our 2 funds is probably copper. We think as a thematic, it's a good green metal, but we're not taking real, what would you call it, minor metal risk, like if you're looking at a graphite or a lithium, It's not clear to me just yet where's my exit out of that equity in that space. I'm not saying that there's anything wrong with, people endeavouring and working hard to get graphite projects or lithium projects up. But from where I'm looking, I've got to be of a consideration who's going to buy this, And even Arrow will be bought, my view, but who knows. But, copper projects, like gold projects, the market gets excited, different types, different parts of the cycle. But, the fundamentals of copper look good. And this was really a new story with a lot of growth in the next 3 to 5 years. And so fund managers like the idea that the fund managers themselves are looking for more liquid, maybe smaller bets than we take, so we can often be up to 50% of a register. It just really appealed. It was a new story, and it's, a fantastic asset. And, they've got 20 rigs drilling since they've gone listed, and they're just finding more and more. So it's been good.
But John, how many institutions do you have on the register that you classify?
No. BlackRock. I think BlackRock were the largest after we floated.
Yeah.
So BlackRock went in and bought hard too, but I don't know where they are. It's run out of London, not Australia.
Sure.
So
But it has
I don't follow the
proper
register.
Institutional following, though.
What's that?
I mean, it has an institutional following.
When they went for the IPO, they got very strong institutional following. So it came out of the blocks day one. Perfect.
But I think that goes to your question, what is the secret ingredient? I mean, the fundamentals, as Verne said, are good. It's a good story. It's a new story. It was in production. But I think I think the difference was it got institutional following from day one, which creates a secondary market.
Right.
The retail set the price, but they're never going to create the depth of secondary market that you need to be listed.
Right.
And I think that's the big difference. There's plenty of other good base metal, well, not plenty, there are a few other base metal stories around. But without that institutional following, you're just at the hands of retail investors. And there's just no depth or liquidity in the market.
And the
But just
production
to turn slightly away from equity, which is what we've been talking about, it's interesting. Sprott are busy closing $1 billion mining credit fund, which goes along with Taurus, RCF, Orion, etc., and other players like that, specialist mining credit providers, and they've raised 850, and they've got to get to $1 billion. And that's an interesting potential source of capital for perhaps mid-caps and the like, maybe even some small caps. They've got to deploy it. It's $1 billion that's looking to be deployed. Now, that's credit or bonds or convertibles or what have you, which is not equity. And for small mining companies to take on debt is risky, depending on their commodity. but it shows that there is alternative capital out there other than just listed shareholder
Yep. Yeah, I
equity
think
providers.
looking at our sort of attendee list, it's across the gamut of capital providers, and there are plenty of people putting debt or forms of debt out there. But yeah, just to reiterate on your point, isn't that a bit too risky for some of these earlier stage miners at the moment that are really struggling to find the capital? It's not an attractive option at all at the moment.
I don't think any junior that takes on debt pre-production, which is a rigid capital instrument that has a fixed repayment schedule, when you have the uncertainties of when the project's going to be built, what the commodity price is going to be when it's finally in production, is madness. And you do see a few companies out there thinking that, just another 6 months away from making a construction decision, we won't take the dilution today, we'll take a bit of alternative debt, if I can call it that. So it's a recipe for disaster in my view. But I mean, Verne's right. I think once the construction decision has been made and a project has been de-risked and you're ready to bring it into production, there are plenty of new alternative debt providers out there who can gear up your balance sheet. But the old rules of gearing and what's an appropriate level of gearing, still apply today as they did sort of 10 years ago, if not more actually, because we're in a more volatile commodity price environment. And I think it's a little bit more difficult to predict where commodity prices are going. So, I think we need to be cautious in how much debt we're taking on.
Yep.
But generally you're seeing debt lenders leaving the sector. So your traditional banks in Australia or whatever, far and far fewer of them, and Europeans are willing to commit long-term debt money to this sector for probably ESG and a number of other reasons. So these specialist funds are filling an interesting void, and they're well needed in the market.
Yeah, and I agree with that.
Yeah.
Peter, you were going to jump in there.
Yeah, we're all wondering, how do we solve this problem of undercapitalized juniors that battle to get money? They've got good ore bodies. They've usually got good fundamentals. They've done as much work as humanly possible to prove how good it is they've got, and they battle to get the money. And I don't have the answer for it, but I don't want to see the sector disappear, and I know the majors don't either, because the majors get a lot of good deals out of these juniors, but there's just more of them than are probably really needed. And I really appreciate them, because we have so many people bringing us projects, and almost all of them have grandiose expectations, and the only way I can bring them down to earth is I show them what these juniors that are listed offer. And it really helps my job a lot, because I'll pull up 3 or 4 Australian Canadians and say, I can't take your project anywhere close to any investor when you're asking all these unrealistic expectations. So I think it definitely helps the majors. They get to pick and choose what these are, but they're so snip at putting any money in them. Investors are so snip, but it's just, there's a plethora of them out there, and it's a buyer's market. And yeah, how do we make it not a buyer's market other than just shrinking the number of them? I don't know, but it provides a very useful benchmarking for mineral investments. And the gap is too big to have them all unlisted, and then you've just got the majors that are listed. There's no transitioning in there. So I think marketing has a lot to do with it, and I think the juniors need to find more examples. That's what's usually caught my attention and some of our clients' attention, to part with their money. If I can rattle off 3 good examples of a very similar situation, I can see the eyes really light up. It doesn't have to be 2 years and I'm going to be producing this, but if it's, hey, in 2 years, we're going to have quadruple the tonnage at a better grade than any of the ones that we want to approach, and here's the 3 or 4 parties we've approached before that have bought similar things. I think there has to be a better roadmap how we're going to make money on this, and it's obviously got to be multiples, but it doesn't need to be through production.
Yeah. A clearer statement of how you're going to make money out of that earlier stage project. Yeah, I'm sure everyone would agree with that. Okay. Anyone got any questions for the panel at all so far? We can run a mic round. Anyone got anything they might want to ask at all? No? Okay, well, let's come back to another theme that we've touched on for various points, ESG. I think there's a lot more that we can cover within that, and how that's sort of shaping the capital that's going into the sector, but also how it's informing your process when you're meeting with companies. What are the sorts of things that you're looking to see now from these companies, from the juniors, that are going to make you confident in taking it forward? Mark,
Yeah, I mean,
sure.
I think the industry has undergone a huge transformation, certainly since I got involved in the mining sector in the 90s at Rio Tinto, who was, I think at the time, was probably one of the thought leaders on this issue. And I think we've all become, ESG is now firmly on everybody's radar screen, and it's become an important part of any running any company and studying and building and operating any project around the world. My sense, though, is that I think we are about to experience a step change in what ESG actually means from a regulatory and reporting perspective. I mean, just anecdotally, the sort of pools of capital that tend to invest in, the Appians, the Tembos, or the Greenstones, the pension funds, endowments, and family offices, their reporting requirements are changing massively, and the number of and I admit this is just anecdotal, but the number of inbound calls we have from pension managers and the like asking us to, and it's scary, right? Asking us, well, can you quantify for us your carbon footprint and the carbon footprint of every company that you invest in, and the implication being, and can you look downstream from the producer? And you sort of sit there as a small company with 10 people in an office in London thinking, how on earth am I going to meet that requirement? Now, it's anecdotal, but I just think it's a reflection of the way we are going, that people want to understand a lot more where their money is getting invested. They want to make sure they're investing in companies and projects that are best in class from an environmental, social and governance perspective. And I think as an industry, as managers of capital and as custodians of the family jewels, the projects, the companies themselves, I think we need to come together and really start to talk about what we're going to do collectively to standardize the way we think about this, because it's going to get pretty chaotic. And the big boys, the BHPs, the Rio Tintos, who are already reporting to that sort of level of sophistication, they have the resources to do that.
Yep.
A junior mining company with a market cap of $50 million or whatever it might be, it doesn't have the sort of bottomless pockets that the BHP do. So I think it's going to be a challenge that is going to step up, I think, as an industry over the next 10 years. And we need to start talking about how we are going to meet that challenge.
Yep, it's making your job a lot harder, but presumably for the benefit in the long run. But you think there's a long way to go before that path is a bit clearer in terms of how
No, I don't. I was talking to John about it. I get again, anecdotal feedback from other managers who are out in the marketplace today, fundraising. Maybe Verne can comment on this, who are, the level of questioning you are receiving from buckets of capital before they give you their money, before they give you their commitment, I think has stepped up massively. Just even in the short, we've been around since 2013. In the short 6 years we've been around, I think there's been a real step change in the requirements. Verne, I don't know if you
a couple of comments, Mark, and I'm in sync with you on that. But firstly, it's interesting, more and more companies in the mining sector, their corporate presentations, page 2 is ESG. It used to be the last page. And then there's a dichotomy between UK and continental Europe institutions for whom ESG basically means like you don't like the planet, right? Whereas you go to the States, and when you have a meeting, they want to talk about ESG as the second agenda topic. And they already have a sort of jaundiced look on their face. And then you go to the US, and you assume they want to go to the ESG page fairly soon on, and I'd say 80% of the time they say, no, we'll look at that or talk about that later. Let's hear about you and the team and the investment strategy and the pipeline and so on. So it's a bit of a mixed picture.
Yeah.
But I guess the big existential question is if the US and UK and continental European and sort of companies that would list typically in ASX, TSX, LSE, NYSE and the like, if they're all going to massively invest in ESG reporting and being monitored and monitoring, and Chinese and other mining companies, India, etc., are not going to play in the same game, it'll be interesting to see, in 10 years' time, who are the winners and who are not.
Yep, that's a very good point. Mandi, I'd like to get your views on ESG because you do quite a lot internally within your team implementing that. How does that change or has it been changing your due diligence as an investor?
Yeah, I think I agree with some of the views that over the last, I don't call it 5-6 years, ESG from some of our clients, certainly here in South Africa, has become a leading question. So you get almost we are required now by some of our clients to do monthly reporting on ESG in terms of what are you doing, what are you invested in, how does it fit certain criteria, what are you thinking about? And certainly looking across a number of different sectors, the mining sector, I think, is one that is seen as an easy, I'd like to say easy ESG target, simply because of the extractive nature that it does. So from an environmental perspective, its impact is fairly large. From a social perspective in South Africa, the number of people that you employ, safety and so forth is a big issue. And governance, I think, is important across all companies. So certainly ESG is a big issue. But I would like to say, I think, for mining companies, certainly the ones that we look at on the listed space are very good or very well advanced on ESG. And that's mainly a function of the requirements from certain authorities. So they are required to meet certain environmental legislation and regulation. So some of that information, I think, is actually available. So I don't actually think it's an additional cost. It's just an additional, maybe, reporting that is required. Certainly not just from, not to government entities, but to the public. And I think a big theme that has come up, certainly because of climate action and climate change, has been sort of investing in coal. And in South Africa, it is quite an interesting perspective when you look at it here, because unlike some of the likes of BlackRock or so forth, ESG becomes a material concern here, because if you don't invest in coal, 76% of our electricity comes from coal. So there's an ESG story there from the opposite side. So the S and the G of that becomes quite material if you don't invest in that commodity. And I think that argument is ignored in some of the more global fund manager discussions.
Yeah, the sort of immediate economic impact of cutting those funds going into these extractive industries. Yeah. Yeah,
certainly. So, like not investing in coal, I don't think is an option for us as South Africans. I think that is actually the responsible thing to do in this country at this point in time. Obviously, our electricity provider over time is looking at diversification, but certainly at this point in time in this developing country, I think coal is still a necessary part of our energy solution.
Yep.
And that is a positive ESG story that I don't think is always spoken about, especially from where we sit here in South Africa.
Yeah, it's proving to be, the ESG means different things in different regions quite clearly, and it's also having different impacts in different regions.
Yeah, certainly. So social issues, I think, in this country, sort of developing social issues, community upliftment, employment are still really major issues, and coal companies, coal electricity companies are still large, I guess, employers, while if you go to the US or in Europe, their energy mix is very different. So coal, not investing in coal is a very easy option, I think, to...
But surely that's a function of government policy as well. I mean, I hear what you're saying, not investing in coal in South Africa, does have an S and a G implication. But surely that's a reflection of government policy. yeah, I mean, because I don't think there are many countries in the world where you would find the same sort of position. And I think in the international arena, certainly, I don't know what you gentlemen think, but from our investors' perspective, don't want to touch coal with a barge pole. I mean, literally, don't want to touch it with a barge pole. And it's a big no-no. And I think there's a practical issue here, which is your electricity makeup is so reliant still on coal. That's a fact, and that's not going to change overnight. But I think also the government has a positive responsibility internationally to put the money and divert some of the capital into other initiatives, R&D and otherwise, to for example, on renewables. Because otherwise, that reliance on coal just continues indefinitely, which I think internationally you're going to struggle. I mean, Eskom there has been some funding constraints over the last, acute funding constraints over the last 20 years.
Some would be an understatement.
And it's just going to get worse, in my view, internationally. So I think that's a big challenge for South Africa.
Okay. Any other comments on that? Peter?
Well, I think the industry's just got to get better at changing the narrative, and the narrative for a lot of young people now, unfortunately I feel I'm getting old, is mining's bad. So you're starting to see it with the way everyone's, the companies are moving quite quickly to say, well, we're going to mine nickel because nickel's really crucial for batteries and batteries are good. And just got to kind of change the narrative and get the industry is crap, sorry for the use of the language, at just promoting even itself. We're often in places in Australia, and we don't finance in Australia, but as a geologist out there, we're in the regional areas where we're the biggest employer. We're probably the biggest employer of Indigenous people outside of the government. But none of that ever comes through. It's just, the industry just doesn't market itself terribly well. So how are you going to change perceptions? Well, you're starting to see it with a number of the juniors even here. They'll talk about that the power coming is hydro, or there'll be a solar farm, and they're effectively greening their product.
Yep.
So that it'll be more palatable to hopefully investors to invest in them. And that isn't a bad thing, but it is, you've got to get in front of that narrative and say, without mining, we're never going to have an EV car, so it's got to be practical. But the industry's got to do a lot about that. And you're absolutely, to just reinforce what Mark says, let's just say there was 1,000 people who were interested in private equity investing in a universe. 900 of them probably aren't even interested in touching resources. So and then you're going through a smaller sieve, and those who do actually want to look at extractive or real assets, as they say, well, they don't want coal, So, it's going to be interesting to see what, especially the oil and gas and coal industry, what they do, because they're in a difficult spot when you start hearing, major sovereign wealth funds will divest their oil and gas exposure, and you'll just wonder where all that's going to lead to, really.
Yep.
So.
Look, I agree 100%, and I have for a long time, which means decades in my book. They don't need to spend that much money of their revenue on marketing, but they need to get some of the .com people that know how to market on their side. And certainly on the African side, jobs. Africa needs jobs. And they've got to say, this mine's creating this many jobs, and they're real jobs, and it's a diversification of jobs. We'll probably never get to how the gold mines used to be here for 80 years, whereas they had hospitals. They were creating so much of their own products they used, like Anglo-American in Zambia. They had their own steel industry, mining coal and manganese to create steel, to build head frames and rail. But I think they've got to get the country on their side, and then the country must help them work on these big sovereign or these ESG funds or funds like BlackRock that are putting ESG at the top and say, yes, those principles count, but we're trying to take these people out of abject poverty. And look at, this mine has created employment for them. It's built houses, schools, hospitals, infrastructure. Whereas selling microchips for cell phones or solar panels for roofs, it's not creating this local industry. And yeah, the mines, they always show new employees and visitors what they're doing, but they've got to get it out there, circulating in the whole world. They've got to get it on the internet, the news, the radio, and they're doing that. They're actually doing it. It's just they got to market and present it. They got to allocate 1, 2, 3% of their revenue spend on marketing their image, and they've got a good story to sell. They're not smokers killing everybody left and right.
Yeah, some above the line.
What they need to get out is that 75% of what this thing is comes out of the ground. They need to convey that to millennials and others. You know, you love your iPhone, 75% of what's in it comes from down there.
Yep. Which is why the phone manufacturers are now recycling your old models, like, you know, and there's much demand for them because they want those precious ingredients back. Yeah. It sounds like, you know, echoing what Julian Trager said this morning on the panel around having more of a B2C mindset or approach that companies could have when they're putting their stories out there. Okay. Well, look, we've got a few minutes left. Are there any more questions, or well, any questions even, or is it beer time?
Beer time.
Beer time, I think. Well, look, let's have a round of applause for our panel, and thanks very much for finishing up today.